What up, my people? How we? Huh? Hi, welcome to my channel. We're gonna be reacting to a lot of financial TikTok and YouTube advice where people are just not giving the best advice, or I'm gonna correct some people. My name is George. I am a credit analyst slash loan underwriter, where I essentially make decisions um, to whether or not to approve a loan, whether it's a car, a house, RV, motorcycle, personal loan, credit card, lines of credits, RVs, jet skis, boats, all those type of loans. So that's what we'll be doing here today. Go ahead and feel free, put any questions you want on in the chat, and I will go ahead and answer them here throughout the chat. So make sure that you guys go ahead and do that. So let's go ahead and get started. Let's see. All right. All right. All right, let's go ahead and start off with this first video. All right, 5 things to never write on a credit application.
Before you fill out your next credit card application, stop. Because these 5 things can get you auto-denied for your next application, even if your credit score is solid and even if your income looks good on paper. I've helped thousands of people get approved for top-tier credit cards, and I keep seeing these same 5 mistakes over and over again. But it's all completely preventable if you know how to speak to the bank's algorithms. This isn't about some TikTok hacks or loopholes. It's about knowing exactly.
My guy said bank algorithm. What the hell is a bank algorithm? We haven't talked about any bank algorithm. What there is called an underwriting system, which is just pretty much an AI version of me that makes decisions on loans. So, wow. Okay. Bank's algorithm, and this guy's he's your king.
What not to write so you never get denied again. By the end of this video, you will get approved for the credit cards that you actually want rather than just settling for whatever will accept you. So let's break down the 5 things to never write on a credit card application, starting with the one mistake that silently flags you as high risk. Even if you never miss a single payment. The first thing that would lower your approval odds faster than anything else is putting down self-employed or retired in the employment section. I know, it sounds crazy, especially if you actually are self-employed or retired, but here's what's happening on the back end. About 80% or more credit card applications are handled through automated computer systems. The remaining 20% either have red flags or need verification. When that algorithm sees self-employed, it immediately flags them as high risk. In the computer's mind, self-employed means that you have unpredictable income. It thinks that you might have good money one month and nothing the next month. The same thing with retired. The algorithm assumes that you're living on a fixed income, probably Social Security, and you might not be able to handle additional debt payments. But here's the hack that changes everything. If you're self-employed, you're really not self-employed. You're employed by your business. Even if you are a sole proprietor, even if it's just you can put down that you work for your business. Don't have a formal business name? Then create one. Something simple like Johnson's Consulting or Smith Marketing Solutions. The algorithm doesn't care what your business is called, it just wants to see that you have an employer. And if you retire but still have some kind of income, maybe you do some consulting, maybe you have rental properties.
Okay. I think it's a solid advice, but it would be being dishonest, which it is not allowed to actually be dishonest on a credit application. So if you're lying, because it's also part of a law with the government where if you are caught lying, you can get fined and maybe do some jail time. Let me find it. Let's see here. That is very interesting. All right, here it is. So, well, this is mortgage fraud, but essentially it becomes the same thing whenever, let me see, it's going to go ahead and be under loan and credit application generally. So essentially doing fraud could be punishable up to a whole mortgage loan or $1 million fine, or you can get hit with both. So you see how, mislabeling can come off as fraud because you're lying the type of employer status you are. But I'm not gonna knock them on the tip. I ain't gonna lie, it's a pretty solid tip to go ahead and trick the algorithm. But just be careful when you do these type of tricks, because again, what someone like me will do is we look up the name of the business. So, and then we have access to different databases that show us who's the owner of what businesses in multiple states. So it's pretty easy for us to just change it to it being self-employed. So I'm just like, why go through the hassle? Because even if you get denied, you can always go ahead and ask for someone to manually review it. Like, it's not that difficult. So yeah, that's that. All right, let's continue.
Maybe you do gig jobs. You can list that down as your employment. For instance, my dad is fully retired, but he still does DoorDash on the side since he gets bored at home. He can put down this company as his employer even though he is retired. The goal is to show stable, ongoing income from a recognizable source. That's what gets you past the first screening. But employment status is just the beginning, because what you put down for your income can make or break your entire application. This second point is where I see people mess up consistently and costing them thousands of dollars in credit limits. Most people make one of these two mistakes. They either put down way too little because they're miscalculating how much they really make, or they put down some crazy high number thinking it will help their chances. Both approaches can give you bad results. Here's what most people don't understand. Credit card companies are asking for your gross income and not your net income. That's before taxes, before deductions, before anything comes out. So if you made $70,000 last year, but you projected to make $100,000 this year, you can put down $100,000. This rule specifically allows for income that you can reasonably expect to earn. I'm not making this stuff up either, because most if not all credit card applications tell you that you can do this in the fine print. Also, if you're over 21 and regularly use your income from other people to pay for your bills, you can include that too. This is for my younger adults that still live at home and working to get their life together. You can factor in that amount of help that you receive into your income. Same goes for your spouse's income. You can include it. Pretty much any money that regularly flows into your household, you can count on it. And here's a pro tip.
Nope, we're not gonna let that slide. Nope, you cannot put any money that your parents put down on a credit application. it's going to be verified. You can't also put your spouse's income. Like when it comes to banks and credit unions, that's a no go. That is a no go for you to put that. So right now, we got him. We got him, chap. We got him. We got him out here giving out advice that he knows no knowledge of. See, this is why, I like to dedicate my time to do these type of videos, because we have people like this that could potentially put you in jail and get you in trouble with the financial institution for misrepresenting. So this is why I'm here to clear this information up. So again, you can't put your spouses, you can't put their parents help you as income. If it's not being reported on your taxes, that's pretty much the best way to judge it, because you have a way of proving it, but even if you do, we can't consider that as income. So I don't know what he's talking about. Let's continue. This is your king right here. This is your king.
If you have any non-taxable income, like VA disability benefits, you can actually increase that amount by 25% when reporting your gross income. The IRS allows that because non-taxable income is worth more than taxable income.
Imagine being able to build an app with your name on it.
I definitely give him that. Yeah, we do gross up your Social Security by 25%.
Wrong on the other end, inflating their income in hopes of better odds of approval or higher starting limits. Now, income is all relative to where you live. It might be more common to find a family that makes $500,000 in New York City compared to a family making $500,000 in the middle of Iowa. Usually, anything over $500,000 might trigger a manual review or a financial review later down the road. And when humans get involved, then they start asking for proof, like tax returns, bank statements, pay stubs. You really don't want to deal with that hassle. Stated income is often exaggerated. However, your credit report can suggest whether your stated income is believable and might influence your approval. For instance, if you claim to make $250,000 a year, but recently took out a small auto loan for $14,000 over a 7-year term, that raises a red flag. Any other negative information on your credit report, such as late payments or persistent high credit card balances, could make them question about your high stated income. The sweet spot is putting down income that makes sense for your situation.
This guy, a whole disappointment. So that whole thing about trying to manipulate how much you get, and then if a manual review gets triggered, the thing is, like, he's not putting where he gets the proof. If you guys go through a lot of my videos, you do hear me not just say, because I am in the field of approving loans, I also show you proof. So there are some underwriting guidelines that I've shown. There are some credit tips that I'm familiar with. I've been a certified credit counselor. Like, I've showed you my credentials of where I worked. So I've backed up what I'm saying. And what this guy is saying, that's something to be very wary. How does he know this information? Who is his source? And he's not putting what his source is. Like, it's not the most difficult thing. It's not the most difficult thing, but it is what it is. Let's go ahead and continue on.
And your existing debts. But income is just part of the equation and is just oftenly used for your starting credit limits. The third point is crucial, especially if you're a renter, because your debt to income ratio is a huge factor when it comes to credit limits as well. Here's what most people don't understand about housing payments on credit applications. When it comes to rent, the majority of the time it's not reported to the credit bureaus. That's why so many credit card applications ask whether or not you own, you rent, or have some other living situation. If you own your home, they usually cancel your mortgage on your credit report when they pull it. So they already know that debt and can factor it into your debt to income ratio along with any other debts that
Yes, it can. Yes, it can. Like, from firsthand, that has access to a credit algorithm and knows a decent of what goes in there, he's capping. They for sure can see your mortgage if it gets reported. This is your king. This is your king.
that you might have. But when it comes to rent, rent, this is typically just self-reported, just like your income. This works off the honor system. I never met anyone or seen any data points where lenders actually request lease agreements or anything like that. The only card that might ask for this is the Bill MasterCard, but that's really just to verify your rent so you can get points for paying. Here's where most people mess up. Overstating your rent makes your expenses seem higher than they actually are, which can hurt your chances of approval. For instance, let's just say that the actual portion of your rent is $700, but you report the full $1,400 rent that you share with a roommate. You just double your housing cost on paper, making it look like you're completely overextended financially. And here's something that I'm sure that most of you already know, but I need to say it anyway. Do not factor in any other housing costs that go into your monthly expenses. Don't include any utility bills, maintenance costs, or anything aside from the actual housing payment. So the fix here is to report only actual housing costs. If you live with your family and pay no rent, then just put down zero. If you split rent or a mortgage with somebody else, then just list your portion. By keeping your housing costs realistic, you give lenders an accurate picture.
Yes, I'll definitely give him some props on that where yeah, making sure that you put the accurate amount down when you go to apply, whether if you live at home, split rent, say that, because that is something that is legal, because that's actually what's happening, and there's nothing that's hiding. And also the debt to income, that is a very true thing also. So your debt to income would be taking only your debts that report on your credit report, divided by how much gross, so how much you take before taxes and everything else is taken out of your paychecks. And then whatever you see after the decimal, so you're going to see 0, or if you're at 100, you'll see a 1 dot, and then you're going to see 3 other numbers. The last number is due to, what is it? When you round numbers, either you round it up or round it down. So if it's above 5, number goes up. So something like 5, 7, 8. The 8 would cause the 7 to become an 8. That's just all that I mean, just in case, if you're not familiar with rounding. All right.
Of your financial situation and avoid unnecessary denials. This fourth point is huge, especially if you are applying for business credit cards. When they ask you what you use your credit for or what type of business that you're in, you need to be very careful about your answer. Certain industries are automatic red flags for banks. Real estate investing, cryptocurrency, cannabis, credit repair, adult entertainment, gambling. These will get you denied faster than anything else. I do not care if you're the most successful real estate investor in your city. The moment that you mention real estate investing on a credit card application, it's going to be much harder to get approved automatically and may require a manual review. Every business has an NAICS code. It stands for North American Industry Classification System. It is basically a 6-digit number that tells a lender what type of business that you run. Every legit business has one. Lenders use your NAICS code to assess how risky your business is. You can find the full list of high-risk businesses linked down below. If you are a high-risk business, focus.
You see, that's what I'm talking about. He showed some proof. I definitely agree with him on that. There are industries that are a lot riskier when it comes. So finally, he's back on track. He's back in, baby. But we're gonna see. We're gonna see as we do. Yes. So obviously, the ones that are really bad end up being anything that is cash only. So you have your strip clubs, nightclubs, DoorDash, any of those type of like ride serving services. Other high risk are going to be restaurants, just because they have a high probability of closing. So a lot of those will fall into very high risk. So you got to look for businesses that are stable. Think about businesses that people need every day, like grocery stores. That's stable. Gasoline, that's stable. Farmer, that's stable, because people have to buy food from you. Yeah, but not like a liquor store. A liquor store is not really too much of a necessity. That would be, I guess, more of a medium risk, but not like a high risk. Just because I was like, people have learned to use liquor for different reasons, so it's very vital in society. But outside of those, yeah, that's what I would say when it comes to those high risk. I'm actually gonna get those codes. I need those codes.
On the mainstream low risk parts of what you do. If you're a real estate investor, maybe you do some real estate consulting. So put that down instead. Remember, you're not lying. You're just emphasizing the parts of your business that banks are comfortable with. But even if you nail the first 4 points, the next mistake can still destroy your chances. Here's something that people should do, but they don't. Most people apply for credit cards without even knowing what's on their own credit report. That is like walking to a job interview without knowing what's on your resume. You're setting yourself up for failure. Here's what happens. You apply for a card, everything looks good, then you get denied. Something was on your credit report that you didn't even know was there. Maybe it was an old account that you forgot about, maybe a late payment from 2 years ago, maybe you left a high credit balance on an account that you forgot to pay off. You need to pull your credit reports from all 3 barrels before you apply for anything. TransUnion, Equifax, and Experian. You want to look at everything. Your personal information, your account history, your payment history. Make sure that your name is spelled the same way everywhere. Make sure that your address is current, and make sure that there are no surprises waiting for you. If you find negative items that shouldn't be there, then you really need to dispute them before applying for new credit. This is where tools like Credit Rehab Pro can be incredibly helpful for identifying and removing inaccurate information quickly. If there are discrepancies between these reports, then it can trigger a manual review or automatic denial. Everything needs to line up perfectly for those instant approvals that we all love to see. So take the time to clean up your credit profile before applying. There's a difference between getting approved instantly or waiting for weeks for a decision that might still be a no. I have created plenty of videos on my channel about DIY credit repair, so check them out after this video if you are in this situation. Before we wrap up, let me give you a few bonus tips that can make a difference between an approval and a denial. First, most people don't realize that every credit card issuer has their own set of rules and approval criteria. Even if your credit card is excellent, you can still get denied if you don't meet their specific requirements. For example, Chase has a rule that automatically denies you if you open too many accounts recently, while Capital One limits how often you can get a new card. These rules are in place because issuers are trying to manage risk. They want to make sure that they are lending to the right people. Second, start with banks where you already have relationships. If you have a checking account somewhere, then apply for the credit cards first. Existing customers usually get preferred treatment. Third, consider starting with secure cards if you are new or rebuilding credit. They are much easier to get approved for and can help you establish positive payment history. And fourth, pay attention to the credit requirements for each card. I also recommend using a pre-qualified tool if the lender has one so you can gauge your odds. If you don't know which card to get next, you can use my card finder tool, which will give you recommendations based on your credit profile with only a soft pull. The link is down in the description. But here's something that I didn't mention at the beginning of this video. Everything that I just shared with you won't matter if you have serious negative items dragging down your credit score. And these items can be costing you thousands of dollars in higher interest and denied applications.
Huh. You definitely gave some good information. Definitely some good information. Well, I'm gonna go ahead and rate this honestly like a 6 on what not to put on the credit report. I think he had a really solid foundation. The problem was just proof. There was just a lot of things, more of like people of me, loan officers, information that we know. And yeah, that is interesting. So, all right, well, that was fun. All right, let's go ahead and go to the next one. Let's see what the next one is going to be.
Stop. Don't get a HELOC until you know about 8.
All right, fixed. Oh, her Honda was totaled, so is her credit. All right, let's take a look.
Yeah.
Hey, how are you? This is Yusuf from Auto Cafe, the car dealer.
Hi, how are you? I'm sorry. I was like,
Calling on your 2021 Honda Civic that has 63,000 miles.
yeah, it has about 63K.
For what you got for me?
So I do want to sell a car because I do want to lease a Mazda. So I'm just trying to figure out like, what should I do, because right now it's in the body shop. I got into an accident about 2 weeks ago and someone rear-ended me. And the car's not going to be ready till like July 15th.
Okay. Are they going to total loss it or they're fixing it?
No, they're fixing it.
Okay. You have to wait till the car gets fixed to trade it in. Obviously, there's going to be an accident on the report, so that will affect the value of the car. What's your credit score right now?
520.
520.
That's BS. That doesn't affect your value at all. Well, I don't want to say at all. It is. He's just saying that for negotiation tactics. He's like, oh, it's just been in an accident. So, yeah, he's starting off bad.
Credit score?
Yeah.
Okay. And I'm assuming you're going to have a co-signer to lease the car because you won't be
What was it?
the value of the car. What's your credit score right now?
520.
520 credit score?
Yeah.
Oh yeah. She
Okay.
would need that.
And I'm assuming you're going to have a co-signer to lease the car because you won't be able to get a lease with 520 credit score.
Yeah, no, my mom, I'm planning on having my mom be my co-signer.
Okay. So if your mom's going to be the co-signer, do you know her credit score?
620 or 650, around there.
Okay. I mean, that's definitely borderline approval for a lease, but 620, 650 on leases, you have something called a money factor, which is similar to an interest rate, and it might still be expensive. You'd have to have somebody with a strong credit profile to get a cheaper payment. Why do you want to sell the Honda? I mean, if it's going to get fixed, and
Look, for people, when the dealerships tell you, like, the credit score, what you need to do is just apply. Like, them shying you from not applying. I don't know if it is legal. If it is legal for them to deter you from applying, only because they know the minimum credit score. They're not the lenders, so they don't know. They have access to their guidelines, but it's just more of a general statement they make. So if you're in that position, I would just go ahead and just still apply anyway. Because I was like, you're still going to need to apply. It doesn't matter. Like, and what he's saying about the credit profile, yeah, the credit profile is not that great. Like, if you got a 620, yeah, like, you got some stuff missed. You got collections. You had loans charged off. You have high credit utilization. You have a lot of debt. Yeah, like if you're around those two scores, yeah, that's mostly what's in your credit profile overall. All right, let's take a look. Let's continue.
and not want to keep it.
Because after the accident, it was a very, very minor accident. Like, it was just like a little bump. But even that little bump turned out to be like this whole thing. So
Do you own the Honda Civic outright, or you're making payments on it?
I'm still making payments on it. I owe about $15,000 on it.
$15,000. How much is your monthly payment?
$370.
I'm not gonna lie. I definitely would just suggest saying that, even though you want a bigger car. I know you're scared because of what happened, but if you get into a lease, you're gonna be paying at least double, if not triple that, plus insurance. So
Yeah, then my insurance is high too. Actually, I don't know why it's high, but it's so high right now.
How much is your
I'm paying
insurance
about
right
$400.
yeah. So now double your payment on your car. Let's say you get at least $700 plus $400. You're at $1,100 a month rather than just paying the $300. And like, are you looking for advice? I'm giving you advice. Stick with the Honda until you.
No, right? Yeah, no. Give me the advice. Yeah.
Yeah,
So how long would you say I should keep the Honda for? Like another year or two?
Why is your credit so low? What's going on? Is there credit card debt? Is there missed payments? Are you late on the payments on your Honda? Tell me what's going on with your credit.
No, it's not the Honda. I have student loans on it, and my credit just dropped because I have about, I think, $20K on there.
How much you make a month right now?
I say $2,400.
$2,400 a month. Okay, means interest goes on the front end, right? So all the interest.
Ooh, girl. Yeah, that student loan. When they said that, yeah, we're going to start reporting it back. And they went ahead and, yeah, I saw so many people be affected with their student loans. Thank God we don't hold a lot of weight to it. So that's a secret. Write that down. That's real. Student loans, we don't consider them a lot. But if you like had it just go negative within a year, it can bring in some red flags. Cause yeah, when it comes to student loans, we don't really use it as a determination to give you an approval on a loan, which the only reason why is because you can stop paying it at any point. So instead of, kind of maybe making a rule, which I think they should still make a rule, like if you have 2 years with paying on your student loans, that they should count that as credit. I don't understand why. I'm actually trying to push that at my job for people that are in college, that if they have at least 1 year of repayment on that we can use that as credit and then be able to make a better decision. So yeah, he's giving her solid advice. Honestly, I would tell her the same thing. I'm like, I was like, insurance for sure is gonna go up just because it's a brand newer car and it's more expensive. Yeah. Oh my god. People just stop getting into car debt. Holy like with me, I pay like $272 right now. Like together with insurance, I pay like $500, which to me is a lot, but whatever. that's why I paid in full. So yeah, wow, yeah, she got us. It's better if she just sticks with the car. Oh my god, people make bad decisions.
Should be added on the front, and you'll never pay the principal, right? So you're making the minimum payment, most of it's paying towards interest, and you never actually eat the balance. Did you graduate college?
No, not yet.
Okay, how long do you have left until you graduate?
I graduate in the spring, so in next May.
The only way for you to get your credit up is to keep making on-time payments on the Honda. In a year, if you make good, consistent payments,
Okay, all right. I mean, that doesn't sound too bad, right?
you're only making $2,400 a month, and if you've got a lease, you'll be paying $1,200 a month, $1,100 a month, which is half your income, so you wouldn't enjoy life, right? You'd just be working to pay your bills.
No, that honestly, that makes a lot of sense. I'm glad you told me that.
Sure. So, yeah, listen,
I
stay the
really
course.
appreciate it. Thank you so much. It was nice meeting you.
Absolutely. Thank you.
Have a great day. Bye-bye.
This is why. This is why. This is why I created this channel. She sounds so young. She's like, oh yeah, that makes sense. I was like, did you not do any homework beforehand? You just wanted to just know right there in the spot. Wow. People, make sure you do your research. If you're wanting to get a car, like me, I want a second car, but I don't want to. There's only a certain amount that I'm willing to pay for it, and I don't want to go too old. So I'm just like, like the car that I would want, my payments would be easily within the 500s. Like, I don't got time for that. That's too much. I was like, too much out my pocket. So yeah, his advice, I would go ahead and give it a solid I'll give him like a 7, because he didn't really give like a lot of good credit advice of how to build. You know, again, dealerships should already know this information, but you know, that's part of it. Like he just said, just make on-time payments, which honestly solid. Like, that's a really solid advice, because it accounts for 35% of your credit. So if you're like have missed payments in the past, or you're currently past due, how much you've been past due affects you. Do you have any collections? Do you just charge off your loan? Do you still owe those collections? Yeah, like a lot of that goes into your payment history. So that is something like, to be aware of. I would talked about credit utilization, and also making sure that the credit utilization, they all are not passing 30%. So the max they can have is 30, but to increase it faster, 10%. Amounts owed, so she owes any credit card debt or any personal loan debts or other debts, like maybe a second car, maybe she has an ATV or a boat. Paying those down, at least if you barely started any, start paying it down to 30%, like within a year. I'm telling you, your credit score is going to go up, and you will be coming back here to thank me. Let's go. Why? Because that's part of amounts owed. So how much you still owe from the balance does play a factor into your credit. So all right, yeah, like I would have offered her some advice like that and got her in her merry way, or I would have recommended her to me. I say, oh yeah, send it to George, the credit expert. That's me. Let's get back to it.
Yeah.
We got a problem.
What?
Mr. Bob.
Yeah.
When I ran your social, it came back as a Shamika Davis.
Who?
You heard me. Shamika Davis. Who is that, and why did your social security number pull back up as that?
Oh, I thought she was going to be a co-signer.
A co-signer?
Yeah.
Yeah. And she lives all the way in Hawaii?
Yeah. That's like my, I don't know how to
You're stuttering over your words.
Sugar mama.
Sugar mama?
Yeah.
Oh, okay. Sure, Mr. Bob. Well, can I see your driver's license?
Absolutely.
Let me guess, you forgot it.
Yeah.
Yep, I know people like you. We ran into these people like you. You got that social security number from the dark web.
Oh my God, you with the feds?
Oh, buddy, I already know. But good thing about it is Shamika got approved. So what I'm going to do is I'm going to call her and still sell her a car, the good salesperson I am. And I'm also going to call the cops, the good civilian I am. Where do you think you're going? Stay right here. That's what happens when you try to scam the dealership.
Are you LLC curious? Wondering, is it time?
That is so crazy that a scammer is calling someone else a scammer. Dealership, one of the biggest scammers out there, because they know you need a car, and they will force, because they know that off top, it gives them a certain power over you, because they're like, well, how are you gonna get to work? Oh, how are you gonna get to be able to travel and do all this stuff? So I really hate dealerships. I've never been a fan of them, especially with how they went on. They just did a market adjustment on cars because there wasn't a lot left. Like those type of people, yeah, I was like, it definitely talks to you about their morals. The morals are really bad, honestly. So, wow. Scammer calling someone a scammer, that's crazy work. Alright. Let's take a look at this video. Alright. Car loan trap explained.
And car payments? Oh my gosh! What are you dragging? Here we go. Yeah. This ain't in my car. Somebody let me use it, bro.
This is the crazy world of the American auto market. American auto loan debt is at an all-time high, now standing at $1.6 trillion. And the crazy part, that's enough to buy every single residential home in New York City and still have money left over. So what do? We've built a society that pretty much requires a car to live in, but cars are now more expensive than ever. Americans have always had a strange relationship with vehicles. They're not just a form of transportation to us. They are status symbols, freedom machines, and for most, a measure of success. Cars allow you to travel the country and explore everything America has to offer. And they've been a staple in our lives since the first car rolled off the line at Henry Ford's factory. Not only that, but we're trained from a young age that a cool car means that someone is doing well. If you see your neighbor pull up in a brand new Lamborghini, he must be doing something right. But as financing and leasing options have become easier to get, that's starting to flip on its head a little bit. You see, the cars that used to provide us freedom and a journey.
No, it's not easy to get a lease. It's not easy to get a Lamborghini. You know how fucking hard it is to get a Lamborghini? If the weight of your debt to income doesn't break you, your credit score will break you. It's like, how dare you try to put in an application for that? You're about to get denied easy. You don't have the credit experience or the income experience if you make the average what an average person makes. Yes, there's ways to manipulate the system, but the only way for that to happen is if it's a system checking it. If it's a human, GG's baby, good game. You getting declined. Go out of here.
Journey through life are now turning into prisons of monthly payments, sometimes ruining people's lives off of a dumb decision they made just to look cool in front of some of their friends. But how did we get here? How could something so amazing turn into a trap for so many? And how did the car dealership industry turn into a loan dealership industry? To explain this further, let's break down what exactly happens when you show up at a dealership to purchase a brand new car. At the dealership, there are four main characters. Number one, you, the buyer. Number two, the dealer, the guy sitting across from you at the desk trying to sell you on that new SUV you just have to have. Number three, you have the manufacturer of the car. And finally, number four, the most important player that hides in the shadows, the bank. This is who really runs the show in the background. And if you're not careful, they will all work together to pull the hood over your eyes and sign you up for a loan that will leave you holding the bag in 5 years. And truthfully, we've seen this before. Remember back in 2008 when realtors were selling homes to individuals that might not necessarily have been able to afford them, but the banks bent the rules just to write another mortgage. And then all of a sudden, the whole house of cards came falling down. Car sales are kind of the same way. You walk into the dealership and you're approached by a salesman. That guy's job is to get you to feel an emotion about a car, get you to fall in love with it, or think about how safe your kids will feel in the back seat, or how cool you'll look pulling up to dinner in that new convertible. The tactics are simple, but humans are pretty simple-minded. If you tell us we're going to look cooler, feel safer, or feel wealthier, we can be easily convinced. So once the salesman gets you on the hook, he takes you back to his desk to talk numbers. As we all know, this can be an annoying back and forth process where you tell the salesman how much you want to spend, they run to their manager in the back, they yap about basically nothing because they already know what their price is going to be. Then the salesman comes back to you, provides you the new numbers, and this goes on and on until you agree on a price. Now, if you're not paying cash, this is where the greatest trick comes into play, the monthly payment. For some reason, our simple little brains are only concerned about short-term pain, and we will do everything we can to avoid it. This includes spreading out the cost of an item over a certain number of months to avoid paying the full amount today. This is the same thing as the buy now, pay later programs I mentioned in this video, but with a car, it can get even worse. Let me show you the car math that schools never teach you, but dealerships know completely by heart. A new car loses roughly 20% of its value in the first year, another 15% in year 2, and 10% more in year 3. Meanwhile, on an 84-month loan, you're only paying about 12% per year towards the amount you owe. The rest is all interest. This creates an equity gap that leaves most buyers owing $7,000 to $10,000 more than their car is worth by year 3, which is why nearly 1 in 4 trade-ins involve negative equity from the previous car. Basically, people are stuck in a debt spiral with no real way out. So let's look at an example. This is a 2025 BMW 3 Series that's listed for $50,000. If you were to put down 10%, which is pretty standard for auto loans, you would pay $5,000 today, which means your loan will be worth $45,000, which sounds somewhat reasonable. Your salesman will then suggest a 72-month loan, and assuming the 7.5% APR we're currently seeing in the market, your monthly payment will sit at about $780, not including taxes and other fees. So for $5,000 today and $780 per month for the next 6 years, you too can drive off the lot with a brand new BMW. Only problem is you're not actually signed up to pay $45,000 over the next 6 years. In fact, if you pay your loan off over the next 6 years without missing a single payment, you will end up paying $56,160, which is over $10,000 more than the original loan amount. And if you show any signs of resistance, the salesman might even lure you in with a lower monthly payment by extending the term of the lease to 84 months. So now you only pay $690 per month, but your total amount then comes out to $62.
That's crazy. Solid advice. This guy killing it. I suggest him. His name is Grant Rudow. You'll see it there in the bottom left. That's good. But the problem is that people just won't. People just won't. They rather have to not argue with somebody than save money, if you really think about it. That is crazy work. Alright. So that's why you gotta figure out. It's kind of easier said than done, but this is the reason why you gotta find out all this information beforehand, so then you won't go over there wasting your time. Because if you have no idea how much you're willing to pay and how much you want the car to cost you at the end, then what are you really doing? So, yeah. Alright, let's continue.
$2,960 if you include your down payment. And the truth is, that BMW you drove off the lot just dropped 10% of its value, and it will never be worth $62,000. You see, dealers have mastered the art of psychological manipulation, and they like to use 3 main tricks. The first is referred to as the 4-square method, where they will intentionally confuse you by juggling 4 variables at once: purchase price, down payment, monthly payment, and trade-in value, all designed to make you pay more and not really realize what's going on. They will write in big letters, scratch things out, flip the paper over, and write over previous numbers, pretty much just to wear you down and make you sign. The second trick they use is called the time pressure close, which is the art of making the deal you're being presented is only going to last for so long. They might even say that the deal is only available today, or that they have someone coming in this afternoon to look at the same car, all in the hopes that they will pressure you into making a decision in order to not lose out to someone else. And finally, the third trick they use is focusing all of your attention on the monthly payment. By steering the conversation away from the total price and towards the monthly payment, they're able to hide thousands in extra costs. For example, they can raise the price of the vehicle but lower the monthly payment by stretching the loan from 3 years to 6 years. By only focusing on the monthly payment, they're hoping that you don't realize that you just went from a 36-month payoff period to 72 months. All they want you to know is that your monthly payment went down by $100. So why do we do it? Why do Americans spend so much money on cars? Well, it's...
Your car insurance company hopes that you never find...
He did that on purpose. He did that on purpose. He's a dick. You can control where you put the commercials. Hate you.
out of our control. Over the last 5 years, we've seen a perfect storm in the car market, driving prices to levels we've never seen before. During the pandemic, the supply of cars fell off a cliff due to computer chip shortages. The factories weren't making any new cars, and the car lots began to empty out. This drove the supply of cars into the ground, and the demand began to skyrocket, leading to even higher used car prices, especially with all the families moving out of the big cities into more suburban areas where they couldn't rely on public transportation as much. On top of that, inflation was close to 9%. So your dollar had almost 10% less buying power than it did in 2019. So as buyers, things were more expensive than ever, and our dollars could not keep up, leading us to where we are today, spat out the other side of the pandemic with $1.6 trillion in auto loan debt. So what can we do to solve this? Well, if you're already in debt on a car, we first need to figure out how much debt you have on the car. So first, let's assess the damage. Going back to our BMW example earlier, let's pretend that we bought that BMW 3 Series in 2021 for $50,000, and now in 2025, we have paid off 3 years of that 84-month loan. In total, we paid the $5,000 deposit plus 36 months of payments at $690 or $24,840 total, meaning we still owe another $33,120 on the loan. We then head over to Kelley Blue Book to find the value of the car, and it looks like our 2021 BMW 3 Series is only worth about $28,000. We are now officially negative on our loan, or underwater as the industry calls it. We still have $33,120 left to pay, and if we sold the car today, we'd only get about $28,000, which means we are $5,120 underwater on our loan. Obviously, not great, but we now know what we're working with. So what do we do now? The first solution you might turn to is refinancing. This is basically the act of selling your loan to a new bank that will provide you with new terms, potentially making your monthly payment less in the long run. More specifically, if your credit score has improved a lot since you opened the loan, or if interest rates have dropped significantly, refinancing might make a big difference for you. But if you're underwater on your loan by over $10,000, or if your car is old and high mileage, most lenders won't even bother trying to refinance for you. So it's really not a solid option to rely on. Other than refinancing, there are a few ways to get out of the mountain of debt you are building, but none of them are going to be easy. First, you could sell the car today and just swallow the loss before it gets any worse. The pros of this is that it's a clean break, but you need to have the cash to cover the loss, or potentially pull out another loan to cover the loss, which I wouldn't necessarily recommend. Second, you could trade the car in for a much cheaper car and set up a new financing plan on that car. This would get you into a cheaper car. You could roll off some of that negative equity into the new loan, but it will also dig you deeper into debt, starting you back at square one on a new loan. The third option is to completely lock down your budget and go as hard as possible to overpay your monthly payments and crush the balance as fast as possible. This requires the most work and discipline, but if you're willing to do it, it can save your credit in the long term and eventually pull you out of this endless cycle of debt. There's also a fourth nuclear option that should only be used in times of crisis because it can have some serious impacts on your financial future, and that is voluntary repossession. You can take your car back to the lender and willingly hand over the keys, which would immediately end your payments, but completely destroy your credit score. As you can see, this is not an option you would want to end up.
Okay, I thought he was going to say something else. I thought he was going to say bankruptcy. I would have definitely went with bankruptcy. So what I would do is, I learned recently that you can do a lease. I've never under in a lease, so I don't know what the requirements are when it comes to doing a lease for a car. But normally, from what I heard in a lease, they'll pack in the negative equity you owe, and then you'll have a lot higher payment, but you'll be able to pay it off because the lease is only in 3 years. And I'm like, oh, not a bad option. So, yeah. Oh. But yeah, I would say that. I was like, normally it's hard to get a personal loan, especially if you have debt on top of what you already owe. Yeah, I was like, a personal loan. Yeah, normally you owe more than $5,000 if you don't have any. If you don't have any, what's called? If you don't have any, any experience, loan experience at that amount, yeah, expect yourself to get declined. You'll most likely need a co-signer also. Yeah, that's tough. Let's continue though. But yeah, getting a repo, yeah, that'll definitely tank your credit, and it'll make it really hard for you to get approved if you need another car in less than a year. So if you end up being in that position, make sure to have 20 to 30%. No. If it's within a year, make sure you have 30% down at least, and make sure that you've been at your job for like 5+ years. That's the first time that's ever happened to you, because, I was like, we can't take that into consideration, and more your lender, so where you work at. Oh, not where you work out. Sorry, where you have your loan at. If you have a lot of other products, they'll take that into consideration when it comes to a relationship, and especially about getting an exception. So, yeah. All right, let's continue this video.
That, but if it's all you've got, then it's what you have to do. When it comes to debt like this, it can be overwhelming, but the longer you wait, the more your car value will drop and the harder it will be to get out of debt. So make the best decision you can today and just get moving. If you're in need of a car right now, here's a simple 3-step plan to get you the best deal. Step 1, get pre-approved financing from an external bank before you walk into the dealership. This will help you avoid dealer financing and other tactics they might use to get you to spend more. And step 2, calculate your all-in monthly cost, including insurance, gas, and maintenance. Because this can and will add hundreds of dollars onto your monthly cost.
He's not lying. That's something that I don't take into consideration, is the maintenance on my car. So yeah, make sure to find out what that is, because I was like, so look into like getting an extended warranty so they can cover you. So yeah, let's do that.
Of owning the vehicle. And finally, step 3, stick to the 24-10 rule. A 20% down payment, a 4-year loan term, and keep the monthly payment below 10% of your monthly income. To make it easy, I linked a simple...
Boom. Let's give him a hand clap. That's a really great tool. I was like, I would definitely emphasize it and do it 30% down, but doing the 30% down is definitely a lot more solid. And maybe going 3 years instead of 4, because if that was the case, I would have paid off my car a while ago. But lower payments. But yeah.
Calculator below that will help you figure out how much car you can afford. When you use this tool, watch how dramatically the total amount of your payment changes by adjusting the term of the loan and the amount you put down. The shorter term loans will save you thousands in interest even if your monthly payment is slightly higher. And just remember, everything is negotiable and you have the power to walk away at any time. The future of car ownership is to be determined. With some instability at the beginning of the year due to tariffs, prices haven't really come down yet. Although with the current trade talks, we're seeing some cracks starting to form, and if demand dries up like it has been recently, the prices will eventually be forced down. So if you're in the car market for a car, new or used, and have the ability to wait, that's what I would do. In fact, that is exactly what I'm doing as someone who is looking to trade in an older, high mileage car that is getting close to its last leg. Analysts are currently expecting interest rates to drop between 0.5 and 1% by midsummer 2025, which could also save you $30 to $60 per month on a typical loan. And by the end of 2025, new car inventory is expected to increase by 15 to 20%, which will also put some pressure on prices, likely driving them lower. So if you can wait 6 to 12 months before buying, you'll likely end up with a better deal. At the end of the day, a car that you're going to drive daily is not an investment, it's just an expense. But if you don't want that expense to end up driving you into mountains of debt, take your time when making the decision and really look into the numbers that are being presented in front of you. Just because it looks like a low cost today doesn't mean you're actually getting a good deal. Don't be afraid to walk away from the table and do what's best for you and your wallet. And definitely don't overspend to get something that makes you look more successful. Instead, save some money to enjoy life versus being trapped under a crazy monthly payment on a vehicle you'll probably grow tired of in the next 10 to 12 months. And here's my challenge to you. Calculate your true car cost by adding your monthly payment, insurance, average maintenance, and depreciation. Then ask yourself, is this vehicle worth X% of my monthly income? What else could I do with that money? If you want...
Honestly, you know what just came to my mind? If you really want to live that type of lifestyle, that you just want to have a nice car, what I would do is I would just rent a car for a whole year. Just rent it. Go on Turo, rent it. Or if it's more cheaper to get it as a car rental, get it as a car rental. It is so cheaper for that to occur. So, well, at least it's cheaper in the long run. Yeah, you'll have to save a lot of money. Like maybe you'll have to save like $10,000. But I don't think you would have to take care of the maintenance. I'm gonna look that up. Ooh, that would be interesting. That could be the new way. And just, there you go. It's like, oh, you can just switch cars every year. So it's like whatever you like saved first, you still save it. So if you want to do that every year, you can just do it every year that way. It's like having a car that you don't need a maintain. Huh. I'm gonna explore that option.
Share your numbers in the comments and we can workshop what the best deal might be. And if you enjoyed this video, you might also like this video that breaks down the psychological trap of buy now, pay later tools.
Oh, that was really good. Let's do that one.
Hold on before you pay for yet another app to manage your team.
Shut up. I actually give him a 7. I give him a 7 on the advice. Really solid advice. I think the difference between him and the other guy is the guy was trying to talk about. He's talking like he has the inside secrets, but he doesn't. But this guy, he's just using the information that's just readily available that you can just validate really quickly. That's why I gave the other guy, I think I gave him a 6 compared to this guy. Because of that. But yeah, let's continue.
Why is paying for so addictive?
I literally once financed a bottle of body wash.
You know what? I'm gonna afterpay this. It's gonna make me feel less guilty to pay it in 4 installments of $81 or whatever.
That's like having a black American Express to me. I can use it anywhere, anytime I get ready.
I'm using Klarna to pay for these Chris Brown tickets.
Look at this chart right here. This shows the total non-housing consumer debt in America over the last 10 years. And in 2024, Americans collectively owe more than $5 trillion, which is enough to pay for every NFL, NBA, and MLB team 10 times over. And to make matters worse, we are constantly surrounded by psychological tricks and hidden fees to drive us further and further into debt. The worst of these tricks, the buy now, pay later programs that have been designed to take advantage of young adults.
So when you buy a $100 pair of shoes and you only have to pay $25 that day, and then the pair of shoes show up at my apartment 3 days later, the shoes are $25. Why do I care if in 2 months I have to pay another $25? I don't know.
That is crazy. She said, yeah, it already came. I don't need to pay it back. Like, and you don't let your credit score tank that bad over that. Like, you really let your credit score go down to the 500s or 400s because you didn't want to pay $150 shoes. That's crazy. If that's you, yeah, you need to contact me today. We gotta get your credit right. Let's do it. Let's do it. Yeah, she definitely does not have any great financial habits. Let's continue.
Me 2 months from now, she can deal with
Buy
that.
now, pay later is a short-term financing option that is offered by companies like Affirm, Klarna, or Afterpay. You'll typically see these options pop up on e-commerce stores, offering you the ability to buy what you want today while deferring your payment over a certain number of installments. So if you're looking to buy a new suitcase for a trip you have coming up and it's going to cost you $300, instead of paying that all today, you could buy the suitcase today and then split the $300 across 4 equal interest-free payments. And you might think, great, interest-free. I can just sign up for these payments and then worry about paying it sometime later down the road. But it's not quite that simple. These buy now, pay later programs aren't necessarily groundbreaking financial technology. In fact, buy now, pay later programs are kind of a newer, modernized version of the old school layaway programs that you would see at stores like Kmart and Sears. These layaway programs allowed you to place a deposit on an item like a dishwasher, for example, and then the store would reserve that dishwasher for you to collect once you had paid off the dishwasher through their installment plan. But these layaway programs kind of fell off throughout much of the mid-20th century, mainly due to the introduction of credit cards and revolving lines of credit. Instead of using a layaway program and waiting to collect their item, people could just swipe a credit card, get their item today, and then worry about paying off that over the next couple months or years. The only problem is that a credit card will incur interest. People realize that if they didn't pay their credit card down on time, they would end up owing more than they initially spent on the item. So along came the modern marvel that is buy now, pay later, which gave you the best of both worlds. Get your product today, pay it off over a longer period of time, all while doing it interest-free. And that idea began hooking people in because buy now, pay later has seen some explosive growth over the last 5 years, going from $2 billion in transaction volume in 2019 to $24.2 billion in 2021. And it's projected to reach as high as $122 billion in 2025. But this explosion wasn't just happening in a vacuum. It's actually part of 3 major cultural shifts that we've been seeing. First is the financialization of everything, meaning we've moved from a completely cash-based society to a society in which we look at even a $5 coffee as an opportunity to finance the transaction. Second, we have the rise of social media-driven consumption. As influencers showcase luxury lifestyle and products, buy now, pay later allows the average consumer the ability to experience the
Yo, no way he just said, yo, finance a $5 coffee. That's crazy. People will do it too. I guarantee it. It's like, I don't get paid till today. Yeah, let me finance coffee. Wow. Ooh, wow, that's gonna become. Oh, I need to get into that. I need to get into. Not gonna be a bad. Yeah. Okay, let's continue this video. Solid video.
Those same things without actually incurring the cost today. And third, we have the post-pandemic spending boom, which has consumers using buy now, pay later as a form of revenge spending or buying things they feel like they missed out on during the pandemic. Combine all of that with a declining financial literacy among most young adults, and you have the perfect storm to make buy now, pay later explode as a new mentality. But why is this even a problem? If they're not charging interest, how can they actually be taking advantage of me as a consumer? To answer that question, we first need to look at the differences between buy now, pay later programs and traditional credit cards. Because on the outside, they're basically the same thing. Both financial devices allow you to buy something today that you might not necessarily be able to afford or be willing to put cash down today for. But a credit card usually involves some sort of approval process, application, review, and a credit report hit. Meanwhile, buy now, pay later programs offer an almost instantaneous approval for your purchase in the moment. Additionally, as we discussed, credit cards can accrue interest if not paid off by the end of the month. And that rate can be at crazy high rates, usually around 19 to 23%. On top of that, if you're late with your payment or you miss a payment, credit card companies can also add on late payment fees that just end up waterfalling you into insane amounts of credit card debt off of fairly simple purchases to begin with. And on the other hand, buy now, pay later offers 0% interest, which sounds great, but that all depends on if you actually pay your payments on time. If you don't, you'll be subject to late payment fees that can range anywhere from $2 to $15 per payment and going all the way up to 25% of the total value of the purchase you made initially. And with all that said, buy now, pay later still might sound like a perfectly good alternative to credit cards, which is exactly what they want you to think. Because buy now, pay later programs weren't necessarily designed to help the consumer like you or me. They were designed for stores and brands that want to sell more through their website or in their stores. After all, that's why brands are willing to pay 2 to 3% more for their transaction fees to use a buy now, pay later program versus a traditional credit card processor. To give you an example, let's look at a $100 purchase. If you bought a $100 item using a normal credit card on their site, the brand was typically going to incur about a $2.50 charge to process that payment. And on the other hand, if you were to use a buy now, pay later program, that transaction fee that the brand has to pay goes from $2.50 to about $5. But the merchant fees are just the beginning when it comes to buy now, pay later. So let's look at how these companies actually make money beyond just charging the brand that hosts them on their website. First, like we just discussed, they're going to collect that merchant fee, which is anywhere from 4 to 6% of the transaction price. Second, they profit from late fees, like we talked about earlier, which has turned out to be a pretty substantial revenue source for companies like Affirm and Klarna, because 1 in every 3 users of these buy now, pay later programs actually ends up missing a payment at least once. And third, every purchase that is made reveals something about you or your shopping habits, and these companies have realized that that is very valuable information for other brands. So they actually harvest a lot of the data from your checkout pages and then sell it to other brands that can then use it in their marketing or in their ad target. And finally, they benefit from the sheer volume of loans being opened up. By packaging yours and everybody else's debt together and selling it to larger financial institutions, they can make money even when you pay on time. In other words, they've created a system where they win no matter what happens to you financially. So now let's look at buying an iPhone for $1,000. When you reach the checkout page, you have 3 options. Number 1, pay the full $1,000 up front. This is the simplest, cleanest, and easiest way to get out of the checkout scot-free. Option 2, you could use a credit card with the typical 22% APR to purchase the phone. And if you only made the minimum payments, you would end up paying about $1,480 over the course of 5 years, with $480 of that being the interest alone. And option number 3 is you could use Afterpay's 4-payment installment plan, where you pay $250 today and then $250 every 2 weeks until the plan is paid off. Which sounds like the best deal to you? You see, brands have mastered psychological manipulation throughout their website, but specifically on the last hurdle, which is the checkout page. And they do this through 4 key tricks. First, they exploit what psychologists call the pain of paying. By splitting the cost over a longer period of time, your brain actually registers less financial pain than paying the full amount up front. Second,
He not lying. I felt like that a lot, where I'll take a longer. But the problem is, if you're not mentally strong, financially aware, there we go. It's like, okay, like, do that. If we're gonna do that, you have to do it in a perspective where you're still pay it off early. So if you're gonna do it in 6 years, still try to do it in 3 years, because what can happen is that, one, you'll finish paying it off quicker, or when you run into financial situations like this and you've paid ahead for so many years, you can stop paying for a while because you've paid for a year. So yeah, so it's like, make sure to be aware of that. But do also be aware, if you are paying it, let's say if you build up a whole year, right, and because you paid it off early, what ends up happening is that you're still going to end up paying interest on it, because they still have to get paid as as a loan, because I was like, it looks like you're gonna pay it off early, but it looks like you just stopped, so the interest just caught up with what you've paid down, and now each time you make a payment, it's gonna go towards the interest instead of the principal. So, or a bigger chunk is gonna go to the interest than the principal. Yeah, something to be aware of.
Trigger what is called the temporal discounting, which is our tendency to value immediate rewards more than future benefits, or otherwise known as instant gratification. Pay just $25 today and it's yours sounds a lot better than waiting and saving up for it. Third, they will create artificial urgency by simulating limited time offers in the checkout page. And finally, they use colors and shapes to direct your eye exactly where they want you to be looking. Have you ever noticed that the buy now, pay later button is often highlighted in a brighter color, and it's sometimes even pre-selected when you reach the checkout page? These aren't accidents. These are specific design decisions to short circuit your brain to making a financial decision more on an impulse than with rational thinking. Instead of thinking about a $100 purchase rationally and over a longer period of time, they'd rather have you just click the pay $25 now and worry about it later on. And again, this isn't necessarily a bad deal, because people are always looking for interest-free ways of purchasing things so that their money can go and earn them more money while they're paying off the other thing that they purchased. But to do so requires some financial education or experience. And sadly, most Americans are completely undereducated when it comes to financial literacy. So the instant gratification syndrome kicks in and they buy practically everything with buy now, pay later, with no real concern that they will in fact have to pay that off at some point. All they're worried about is the price that they will pay today, which is exactly how you end up with this.
I've done groceries. I've done all kinds of crap on Affirm and Klarna.
Imagine being able to build anything just by thinking about it. Meet Base 40.
And then you are in a chokehold. And in some ways, it is worse than having the credit card payments. It's crazy.
Because buy now, pay later is so easy to do, people are starting to use it on more and more occasions where it's really not meant to be used. Instead of just using it on a big purchase like a new fridge or a TV, they're starting to use it on smaller things and truly financing items that have no business being financed. A crazy story that we recently saw is that Klarna is now on DoorDash, which allows you to finance your $15 burrito over 4 payments of $3.75 instead of paying the full $15 up front. Again, not a necessarily terrible thing when looked at in a vacuum, but when you expand this to consider that someone who's financing a burrito is also probably financing a lot of other things, that's when the real problem starts to arise. Bad spending habits like this lead to what we call loan stacking, pretty much what it sounds like, taking out loan after loan after loan and stacking them on top of each other. And because buy now, pay later programs make it so easy to do so, most consumers don't even realize how much debt they're actually accruing. In fact, in 2022, 63% of buy now, pay later borrowers had more than one loan going at one time. And this is where it gets really scary. Because these programs are designed to offer credit with little to no approval process, it's almost like they're targeting people that don't know how to manage their money. All they see is, oh, I can buy this $1,000 thing for $250 today, and they just click buy. When in reality, over 69% of buy now, pay later users are already in debt on another credit card. And 28% of buy now, pay later borrowers are between the ages of 18 and 24 years old. Most of these people don't even understand the concept of how a credit card works, and by giving them this buy now, pay later option, it's almost like they have this unlimited stream of money that never needs to actually be paid off. Again, don't get me wrong, there are definitely some advantages to the system if you know how to play it, but the vast majority of people using the system are not taking advantage of it, they are just getting taken advantage of. So what do you do? As a consumer, should I completely stay away from buy now, pay later, or are there some circumstances where it makes sense? And to answer that question, the most important piece of advice I can give you is to never spend more than you currently have, whether that be through a credit card or a buy now, pay later option. If you don't have the cash in your bank, don't spend it. And that is by far the easiest way that you can keep yourself out of credit card debt. And if you feel confident in your financial abilities, feel free to use a credit card or a buy now, pay later option to earn more interest on your cash while it's sitting in your account versus just spending it immediately. But if you don't feel confident about this, treat your credit cards and a buy now, pay later program as if it's hooked directly up to your checking account. If you spend $100, that's $100 coming directly out of your account. Another tip I have is to avoid stacking these loans, because that is where things can get very messy very quickly. If you start financing weekly expenses like gas, groceries, or that Friday night Chipotle bowl, it becomes a slippery slope, because it is 100 times easier to get into debt than it is to get out of debt. But there you have it, the truth about buy now, pay later. These companies spend millions of dollars on psychological research to get you to spend more than you can actually afford. But now you know a little bit more about how to protect yourself. And if you like this video, make sure to check out this video that covers the business of Formula One and how billionaires use debt to fund their crazy hobby of racing.
Wow. Wow. That's all I gotta say about that. Well, this has been very fun. Alright. Alright, I will see you guys next time. Remember, put your questions below.